All right, today we're pulling back the curtain on something fascinating, the secret world of alternative investment funds. These are the powerful and often invisible financial engines that are out there fueling innovation and honestly building empires.
You ever see a startup and think, how on earth did they get millions of dollars in funding before they ever sold a single thing? Well, I can tell you it's not magic. It's a very specific, very powerful type of investment machine that works almost entirely behind the scenes. To get this, you have to realize we're basically entering a parallel financial universe, one that plays by a completely different set of rules than the stock market that we all know.
Right, so most of us are familiar with traditional investing, right? Buying stocks, bonds, things you can trade pretty much any day you want. Alternative investing, totally different beast. This is all about making huge, long-term bets on private assets. Think of that promising new tech company that you absolutely cannot cash out of easily. It is a marathon, not a sprint.
So what is an alternative investment fund, or AIF, at its core? Well, the key words here are privately pooled. It's a fancy way of saying the fund gathers enormous amounts of cash from a very select group of savvy, sophisticated investors. And they do this to jump on these massive opportunities that you and I, the general public, never even get a chance to see. Okay, so if they're making these huge bets, where does all this money actually come from, and who's in charge of managing it all? Let's take a look at the key players.
We're talking about the real heavyweights of the financial world. These aren't small-time players. We're looking at massive pension funds, incredibly wealthy individuals, and other major institutions. They've got the two things you absolutely need for this game: deep pockets and a whole lot of patience.
And here's what's really interesting. They don't just write a giant check on day one. The whole system runs on what's called commitment and drawdown. So an investor might commit, let's say, $10 million, but the fund manager only calls for that money in pieces as they find real companies to invest in. It's super efficient, making sure that big money is only put to work when a genuine opportunity pops up.